Hello and welcome back to Volatility 411. I'm Kevin Davitt, part of CBOE's Options Institute, and it's Monday, August 23rd. So what a difference a couple of days can make. As I sit here, the S&P 500 index is 2.6% above the Wednesday lows and right back at all-time closing highs. The VIX Index flirted with 25 in the middle of last week, and it's now measuring just over 17. As of Monday morning, the S&P 500 is right around 4480. So that's higher by 0.9% on the session. The market seems to be brushing off higher COVID infections, poor retail sales, and weak consumer sentiment numbers. Last week's SPX option volume was very heavy into the standard August expiration. Russell 2000 index option volume was the highest in over a year last week. The RUT closed just below its 200-day simple moving average on Thursday, but has since rebounded. VIX option volume was in line with its longer-term averages, right around 500,000 per day. Now looking at the VIX futures curve, the spread between September and October contracts is out to $1.85. Now that closed at 160 wide on Friday. In other words, the front of the curve is steepening. Now shifting our attention to VIX options. Today, the November-December 40 call spread traded a few thousand times at 20 cents. The December options over in that scenario. Also of note, the standard September expiry 17 strike puts are trading very actively. More than 15,000 of those options are on the tape. They mostly traded around 55 cents, and the open interest on that series is well over 220,000. Now the futures reference on those trades is 1970, so those puts are about 15% out of the money with 23 calendar days until expiration. This week we'll focus on the Jackson Hole Symposium for the Fed, revised GDP data on Thursday, and consumer sentiment on Friday. That's Volatility 411 for Monday. Thank you very much for tuning in.